Okay, so now we're going to get into kind of the meat of this, which is the key considerations. We've talked about sources of capital, why raise capital, what would you do? And so now as a management team, you need to think through what are the key considerations that I as a management team take into consideration, but also the trustee. And on the left, you'll see this graphic on accretive versus dilutive analysis. The important thing is just that if you're going to take on an investment, the value or the earnings per share of the company should get better. You may take on a project that's short-term dilutive because long-term it's accretive, but generally you're looking to invest money that's going to have a return in the future. One comment that we wanted to cover today was, what does adding debt do to my valuation? Well, I think if we think of this in stages, if I get a loan today for $20 million, then my amount of debt goes up 20 million. You'd say, okay, well, my valuation just went down 20 million. But on day one, that 20 million is just cash. So as soon as I get debt, acquiring debt has no impact on value. Deploying the debt does. And so when we think about the accretive versus dilutive analysis, I may borrow 20 million today with the expectation that it's going to generate 30 million in return. And so I'm a net $10 million better. And so when we think back to that unproductive debt, the repurchase obligation, those are things that are necessary that may be short-term dilutive, but long-term beneficial for the company. And even with repurchase obligation, you would have to fund that with cash regardless. And so borrowing for debt allows you to stabilize your cash balance, maybe with a mix, as well as, kind of as we said, transfer your cost of equity into a cost of debt.
So Joseph, can we take a minute on that one, specifically on the repurchase obligation? And you mentioned you're transferring the cost from an equity cost to a debt cost. Can you, and let's make sure I'm understanding what you're saying correctly, is that you're assuming that there's, for example, a 5-year payout. Greg leaves the company, and over the next 5 years, the company is going to buy back my stock. So this is not a segregation type situation, but rather Greg is going to get bought out this year. He's going to get 20% bought out at today's stock price of his shares. And then next year comes around, they're going to buy the other 20% at next year's stock price, and so on. Is that what you're thinking about?
Yeah, exactly, Greg.
So in my case, I just said, well, you paid for 20% of the shares at $100, and then say, let's go for next year, stock price goes up to 120. Well, then they're going to buy 20% of my stock at 120. And effectively, what you're saying is the company, instead of spending buying all of my shares back on day one at $100, they're unfortunately cost averaging up and paying me out at the growth rate of the stock price, for example. So if the stock is growing at, in this case, 20%, it costs 20% more to buy me out, but the company got to wait a year, right?
Right.
So if you borrow instead, you're saying if you borrowed the money and said segregated everything, for example, and said, let's just borrow we don't have all the money to pay Greg out today, but if we borrowed money at say 7% and segregated that stock and said, he's going to get paid out over 5 years, but it's at this price, then you've saved, because your net spread between your borrowing rate and your, let's call it near term, long term, 5-year in this example, equity stock price growth rate, that's what you pick up as a company. You get that gain. I'm not paying 18, I'm paying 6 or 7 or whatever that tends to be. And that's the gain of the company. Is that what you were speaking or alluding to?
It's exactly right, Greg. I mean, you can almost think of someone who is owed a repurchase obligation over a 5-year period as a lender. And the cost is the cost of the shares going up, like Greg said in this scenario. And so you can transfer or refinance your repurchase obligation to a lower cost of capital and then pay them out over a shorter period through segregation. We'll go into a little bit further detail on that in a couple of slides. But that's really talking about, again, what that dilutive analysis could be. Is that maybe worth it on day one to be slightly dilutive? And that's really in that section D, when your RO is so high that you need to push yourself back into C. it may be worth it to be dilutive for a year to right size the repurchase obligation and change that cost to make your ESOP more sustainable. Well, let's go back to these more fruitful initiatives. And so the company, the management team has said, I want to go through this. What is the trustee going to say, right? Well, how does this impact my participants? If we're acquiring a company, I'm going to add new participants. So how are we going to integrate those people into the plan? How does it change the future share price trajectory and my potential benefit level? Can the company cash flow the near-term repurchase obligation in light of this additional debt or risk and use of cash flows? Those are kind of some trustee considerations. The management team, again, will think, how can I fund my debt service? If I'm layering on reinvestment, what cash flows can I take on as a company today? How much risk am I willing to take into the future? And if I don't have an initiative, we kind of going back to our repurchase obligation, if on an annual basis I say I don't have anything, the acquisition market isn't great, we've expanded last year, we're waiting for some cash flows to generate from those projects, it may make sense to treat a pre-funding of repurchase obligation almost like a dividend recap, putting some cash in the plan to pre-fund RO, managing the cash balance on the company, which in short lowers the share price, but as the participants are indifferent because it's just transferred for cash. And so that's something on an annual basis a management team may think of, because we want to stay out of stage D. We don't want to get there, and that's a way to right size that on an annual basis.
Right, if you're in a position where you're generating a lot of cash, but at this point at least, I'm not saying all the cash, if you're generating a lot of cash and you don't have anything really productive to do with it, you're saying, I don't have an acquisition, I don't have any real growth opportunities that I can see right now. You're saying that there may be an opportunity to take some of that additional cash flow and potentially pre-fund?
Yep, exactly. And again, that's going to have a lower cost because the cash will be there.
Right.